Good morning, traders. Welcome to the live stream. My name is Charles Gough. I come from a community called Pirate Traders where we are focused on the ES, the NQ, and how they move through the two-way auction process. A lot I want to talk about this morning because this is just one of those days where the market can drive you a little crazy, right? Some interesting things happening here in the market that are worth discussing. So just to give you my rundown real quick, as an intraday trader, I am bullish on the market. I think the market wants to continue this momentum to the upside. But as a swing trader, I feel like this momentum needs a reversal. We need a correction. So this morning, I thought we'd spend a little bit of time talking about these types of markets, right? How we get these types of markets and then how we handle them when we get them. If you don't mind, if you're watching this live right now, please smash that thumbs up, give us a like and say hello in the comments. If you have any questions throughout the stream today, go ahead and ask those in the comments and I will get to them. If you are watching this from Bookmap's Discord, you can look for the tab that says Futures-Charles and you can ask your questions there and I will make sure to answer them in a timely fashion. Dan's in the house. Good morning to you. Okay, so I would describe the market right now, and of course we're talking about on a daily time frame. So from one day to the next, to the next, to the next. I would describe the market as getting itself overly long, overly fast. And what do I mean by that? I mean that the type of momentum that's pushing the market up is a combination of short covering and FOMO buying. So when a market is moving higher in a healthy way, it does so by creating dips. So it goes up and it comes down and it dips, and then it goes up again and it comes down and it dips, and then it goes up again and it dips like this, right? That's a healthy move to the upside. And the reason that that happens is because people that didn't buy the first dip, they chase price on the next dip and then they get in. And then the people that didn't buy either of those dips buy the next dip, and the ones that didn't buy those dips buy the next dip. And as long as you keep doing that, then the momentum continues and the market can go higher. That's a healthy move for a market. But you can also get a scenario where the market moves higher, then it just goes sideways at higher prices. It never dips back down, and then it pops higher again. And it just goes sideways at higher prices. It doesn't dip back down, and it just goes higher again. This is a much more unhealthy type of market. And the reason that we consider this market to be more unhealthy is because it never allows people to buy a dip. So who are the traders in these markets when it's doing this? When it's just pushing higher, going sideways, pushing higher, going sideways, pushing higher? Well, they are a combination of shorts that are covering and FOMO buyers. So essentially you get the first move to the upside, then you get two-sided trade. Some people are shorting because they think the market is going to dip, right? And there are buyers that think the market is going to keep going up that are buying. And so the market goes sideways. Once the market breaks that little range and it starts to pop up again, what happens? Anyone who is shorting in there starts to get squeezed. And so you get a quick move to the upside. Well, if that process continues, who are those new buyers that are buying up there? It was short covering that got us up there. Who's doing the buying? Well, FOMO, right? People chasing price. And there's a big difference between people that buy dips and people that buy FOMO, that chase price. The difference is people that buy dips tend to stay in the trade for much longer, whereas people that chase the price, people that are FOMO buying at the high, tend to get squeezed much faster. They tend to give up on their trades much more quickly. So if a market, works its way up like this, it may get a little bit of a correction, but it won't squeeze all the buyers. And so it can turn around and keep going up. Whereas if the market works its way higher by going sideways, popping up, going sideways, popping up, going up, it will often crash back down, taking out all those buyers on the way up. So when I use the expression that the market is getting itself overly long, overly fast, that is what I am talking about, is that it's all short covering and FOMO buying, chasing the market up, that is creating that momentum to the upside. Okay. So that is what we have right now in the market. If you look at the last week or so of trading days, what do you see A lot of red. What is all this red on my market profile screen right here? Each one of these is a reference that we call a weak or poor reference. That implies that the auction didn't come to an end. That implies we didn't get a really good dip. We didn't give those strong hands a chance to step into the market. That implies. And the more of these weak references that we build up, the more likely the market needs a correction. It needs a dip to clean all of this up. So you say to me, Charles, we hear you. The market is getting itself overly long, overly fast. It needs a correction. We're going short this morning. Yay! No. Because the thing about this type of momentum, the thing that makes this frustrating, this shorts covering, FOMO chasing, shorts covering, FOMO chasing, is it will shock you how far they can push it. It will shock you how far it can go just continuing to do this process. Now, whenever it's done, it's going to correct and it's going to come back down, but you don't know, you can't time ahead of it when that correction is going to happen, right? So what you have to do as a trader is you have to be of two minds. You have to have your day trading mind, which is shorter term trades that I'm going to execute based on what's happening right now in front of me. And then you have your swing trader mind, the longer term, bigger swings that you're going to try to take. As a day trader, there's no reason not to be bullish this morning. Okay? Let me just walk you through some of the reasons to be bullish today. One, yesterday's profile, Friday's profile, was what we call an elongated profile, where the market spends some time, brings in some volume, pushes higher. Time and volume pushes higher. Time and volume closes at the highs. That's a sign of momentum up. The fact that we left behind single prints on Friday is a sign that when the market closed, there was still momentum. The market still wanted to keep going up. Now, we've still got 20 minutes before the market opens, so it's too early to say we're definitely going to have a gap. But if the market opens right now at 64.34, we have a gap up. Guess what a gap up is? Another sign the market still has momentum up. Okay? So Friday's range was bullish and telling us the market was likely to keep going higher today. The overnight range is bullish and tells us that the market is likely to keep going higher today. And on top of the fact, the high that the market made this weekend, around 64.58, that is a weak all-time high. Because whenever the market makes an all-time high, that is not during the regular trading hours. It's not Monday to Friday, 9:30 a.m. to 4 p.m., that high has a very high probability of being tested during a subsequent regular trading hour session. So the fact that we left behind that weak high in the overnight market is another reason to assume the market can continue higher today. So as a day trader, everything is bullish right now. So what are we watching for once the market opens, right? We're watching to see, first off, do we get a gap up? If we get the gap, and again, we still have 20 minutes till the market opens, so we don't know yet. But if we get the gap, that is a sign to be bullish. We will look for support at yesterday's high, or at least around yesterday's high. I would say above 64.26. If we get that support, we look for that continuation up to 64.58. Okay? If the market fills the gap and it does not get support, that's a sign it needs to start a pullback. But we don't know how big of a pullback. Remember, the market still has momentum. So if we start to spend time and bring in volume inside of yesterday's range, again, this is in the scenario where we open with a gap up, then the first target to the downside is repairing the weak reference at 64.21. New selling there takes us down to 64.16. New selling there takes us down to 64.10. New selling there takes us down to 64.02. Okay, so the market could reverse at any of these levels, but we'll just have to monitor for continuation lower. Now, let's say we open inside yesterday's range. Let's say we actually open down here around 64.26. Well, then I would use the area above the single prints at 64.16 and the previous day's high, Friday's high, at 64.31 as a chop zone. Let the market grind around in here, and then when it breaks one end or another, look for either continuation or failure at those levels. Okay, but let's not worry about that. We still got 20 minutes. I will discuss whatever's happening in real time once the market, gets there right before the open. For now, let's just spend a moment discussing this concept of momentum running out, right? Good morning to Trader. I like to think about momentum like it's a speeding train. So when the market is moving in a certain direction, say it's going straight up or it's going straight down, it's like a speeding train that's moving in that direction. Trains don't just instantly reverse, okay? It can technically happen. You can get what's called a V-shaped reversal, but it's not as common, okay? Most of the time when the market has momentum, particularly to the upside, that momentum has to roll over. It doesn't just instantly reverse and start going down. So let's take a look at the daily chart and kind of look for examples of when we've had moments like this in the past. So what we're talking about is the fact that we're going so far, so fast, right? And we need to dip back down. If we just zoom out and we just look at the chart for previous examples of when this has happened, here's an example right here where the market was getting itself overly long, overly fast. We got a dip. We had one big vicious day where the market came through the last 3 days lows, but then it turned right back around and kept going. Okay. Here's another example here where the market was getting itself overly long, overly fast. We did have a dip on a particular day that came down and cleaned up the previous day's low, but then we bounced the next day, and it was only like 3 days later that we got that bigger dip to the downside. Okay. Let me zoom back here. So here's one here where the market was getting itself, overly long, overly fast. Okay. It had one day where it just went sideways before getting that pullback on the next day. Okay. So if you see, if you're ready to open your chart and you're saying to yourself, oh man, this thing has got to pull back. It's got to correct. Look at how much weak references. This momentum has got to come to an end. Look, the volume is tapering off. This has got to be the high. That is not necessarily a reason as a swing trader to immediately go short, right? Because it could just keep going. It will shock you how far it can keep going when it's got this kind of momentum. It can just keep chugging along, taking out traders again and again and again for days, even weeks at a time. So that is why I say as a day trader, we should be bullish because it's telling us we still have momentum and the market can keep going up. And as a swing trader, we should be waiting to buy that dip. Now, as a swing trader, I don't want to be long up here, right? As a swing trader, this is too far, too fast. There's no reason to take on the risk of getting long at the highs, but I also don't want to be short. I want to be waiting to watch the market roll over. So then you say to me, okay, what is the sign that the market is rolling over as a swing trader? Well, as a day trader, what is the sign the market needs a pullback? If it starts to spend time and bring in volume inside yesterday's range. So if it gets below 64.31 and it starts to spend time and bring in volume there, that's your sign you need to pull back to 64.21 and then 64.16 and then 64.10. Okay? That's intraday. On the daily time frame, it will be how many of these weak references get repaired. If the market dips today and it just pokes in there and takes out one or two weak references and then bounces up and out of here on a swing basis, we still have momentum and it's not time to short yet. If the market comes all the way back down and gets below yesterday's low, gets below Friday's low at 64.02, then on a swing basis, we need that larger pullback. Also, another sort of key indicator today will be where does the market close at the end of the day today? If we close at the end of the day today above yesterday's range, above Friday's range, well, then that's a sign on a daily time frame that we could get another move to the upside. If we close back down inside Friday's range, well, then that's less bullish. And if you take a look at Thursday, this is what happened Thursday. On Friday, based on Thursday, where did the market close? Above Thursday's range. And so what did we get over the weekend? Another move to the upside. So we got to think about it like that. If we close today above yesterday's range, we don't want to be short as swing traders because we could get another overnight that makes new highs. So all in all, at this very moment, 15 minutes before the market opens, I would describe myself as cautious and awaiting more information as a swing trader and bullish as a day trader, assuming the market is going to find support somewhere above, 64.26 and then continue the momentum to the upside. I will only change my mind and start to get bearish as an intraday trader if we start to spend time and bring in volume inside yesterday's range. Any questions on any of that from the chat? Any questions? Good morning to Croco. Hoi, hoi. Billy K in the house. Good morning to you. Laura is here. Welcome, welcome. Guillermo in the house. Tom is here. He says, male. And I went to Led Zeppelin concerts. That's funny. He's responding to the fact that YouTube is telling me the latest video I posted on YouTube is only being watched 100% by men between the ages of 35 and 44. And I was like, that is very specific. And so Tom is clarifying that he is over the age of 44. Well, you must search for things that young people search for on YouTube. And so YouTube has classified you as being younger than you really are. You got to start watching some of those Zeppelin, those old Zeppelin concerts on there. It'll pick it up quick. Rich in the house. Good morning to you. Jarrett is here. He says, how can I use the aggressor gauge, that one at the bottom of Bookmap? What is VPI? That's a great question. So that is the volume pressure imbalance. And basically what that is measuring is, and this is like second by second in the way I have the settings set up, it's telling me right now at this exact moment, are there more buyers or are there more sellers in the market? Meaning the orders that filling, are they long or are they short in this exact moment? Okay. So when you see that it's on the red side, that means that there's more sellers in the market at that exact moment. When you see that it's on the green side, it means it's more buyers. Now, the way I have the software set up is that if we cross the threshold of 95% of the volume pressure being one way or the other, it makes a little clicking noise. You actually just heard it a second ago. As they took out these stops, these 138 stops, you heard that little clicking. Because at that exact second, at that exact moment, most of the liquidity in the market was stops getting taken out, right? Which is longs going short, right? Getting out of their longs. And so for just that 1 second, while the order book was sweeping, while it was clearing out those orders, there was way more shorts getting filled, right? So at that particular moment, the volume pressure crossed that 95% threshold to the downside. It can do the same thing to the upside, right? If they were to poke up, let's say they were to poke up above, 64.40 right now, the same thing would probably happen. It'd be like click, 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 and then pull back down. And in the moment that it's clicking, that's shorts getting stopped out, right? So how do I use that in my trading? Well, it's basically an indicator for me to pay attention to the market, because it is not common that you're going to get more than 95% of one side's pressure or the other. Most of the time, most of the day, it's going to be somewhere in the middle, right? It's going to be pretty close to about the same most of the time. So it may bounce between like negative 50% to positive 50%, and it'll kind of just bounce back and forth like that. But if you get 95% on one side or the other, that means they're sweeping the order books. That means they're taking out stops, okay? That is very important, because oftentimes, if there is going to be a change in the market, so the market is going up and it's going to stop going up and either start going sideways or pull back, or the market is going down, it's going to stop going down and either go sideways or pull back up, right? It will first happen with a sweep of the order books. So again, I'm not making a prediction about what's going to happen over the next 9 minutes, but let's just say the market was going to find support here at yesterday's high and turn around and start heading back up. It will often sweep a bunch of stops there first. So it'll come in, click, 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 turn around and start heading back up like that. Okay. So whenever I hear that noise, I know, Charles, this is a moment, no matter what you're doing, I might be busy watching a YouTube video, I might be busy doing something else. At this exact moment, I need to turn, I need to look at the screen, and I need to observe what's happening now. Because what happens after you sweep the order books tells you what comes next. So in this case of this morning, what does it mean? We swept the order books, we tried to bounce, and now we're right back at those same levels. So that tells us the market needs to dip into yesterday's range a little bit, right? It tells us we're not going to get a bounce straight up and out of here. Okay. Again, doesn't matter. Market isn't open for another 8 minutes. We don't really care. But over the next 8 minutes, we're likely to dip down a little bit. Okay. Probably towards, 28. So that's what it tells us. So anytime the market is range bound, it's grinding in a range, you will get these sweeps at the highs and lows of those range. That might tell you it's ready to break one way or the other. If the market is trending in a certain direction, if it has momentum and you get the sweep of the order books, it might be a sign the market is about to go sideways or pull back with price. And so that's how I use that volume pressure indicator. Any other questions? Zima says, I can't afford Bookmap, so I watch the live stream. Well, that's a great place to start. Watch these live streams, learn all you can. And then when you are in a position where you can, afford to start paying for Bookmap, then you can use it because you've built up that skill set. You understand, how it works. Not to attack you personally. This is not even geared towards you. This is just a general statement towards people that enter trading. If you cannot afford to spend a couple $100 a month, to invest in the software that you need in order to be able to trade the market, you are not financially ready to be a trader. Part of being a trader, and there's a difference between being an investor and being a trader. Right? Anyone can be an investor. If you got $1, you can be an investor. Okay. But to be a trader, to be somebody who is entering and exiting trades over and over again, you have to be financially comfortable because part of trading is risking losing money every day. You got to risk losing money. And emotionally, that is very, very difficult. So if you don't have a little bit of a nest egg, a little bit of a cushion, it's very, very hard to be a trader for anyone, especially if you're trying to learn how to trade. If you're trying to learn how to trade for the first time and you only have, $500 to your name and you put that $500 into a Robinhood account or whatever, and you think, okay, I'm going to start trading, you will likely never be a successful trader. It has nothing to do with how smart you are or how hard you're willing to work or any of that stuff. The fact that you don't have a little bit of a financial cushion is automatically working against you. It is a headwind in your progress. Okay. So what I always tell people is if you don't have at least 20 grand that you can commit as risk capital, meaning you could lose 20 grand and it would be fine. It wouldn't affect your life in any way, shape, or form. You should probably in the short term just be a long-term investor. So just buy, QQQ or SPY or something like that and save your money, right? To get a second job, get a side hustle, do other things to bring in more money. And then once you are comfortable financially, once you've got, 6 months worth of living expenses in liquid savings, once you've got a little bit of a long-term investment portfolio, then you can start to actually risk capital as a trader. And the good news is you can still practice trading in between. I just recommend you do paper trading. You don't trade with real money. So whenever somebody says to me like, I can't afford to spend a couple $100 a month on software, that is an instant red flag to me that they are probably not financially secure enough to consistently make profits as a trader, no matter what. Because psychologically, money is a fear. It is a mental factor that will hold you back in your trading. So nobody likes to hear that. Everybody hates that advice, but that's the best advice that I have. If somebody comes to me and they're like, hey, my kid wants to get into trading or whatever, often when I chat with them about what is your kid's situation, the truth is they should get a second job. They should save more money. They should get themselves in a much more, comfortable financial position. Then they pursue short-term trading, But this is a rich man's game. The more money you have, the easier trading is. And a big part of that is psychological, right? It is about the psychology of what you feel when entering and exiting trades if you have money fears. But I do think you're doing the right thing, watching the live streams, learning how to use the software until the day comes that you could spend a couple $100s a month on software and you wouldn't even care. You wouldn't even blink. That'd be nothing to you. That's when you start trading. Trevor in the house. Crypto Writer is here. Al says, Charles, for your bias for the day, do you use like prior day's value areas or prior day's range for direction? Like stick long as long as you're above the previous day's value area high. So not specifically the value area high, but yes, I use the previous day's levels as the levels to understand what's going to come next. So for me, now that we're about to open inside the previous day's range, the levels that I'm using are the base of the single prints up, which is 64.16. Okay. That's from Friday. And Friday's high, 64.31. And I'm saying that's a chop zone. I'm saying we could dip down in here and it's not bearish because it'll just turn around and go right back up. Or it can look like it's about to break higher and it's not really bullish because it can turn around and come right back down as long as we are in between that range. Remember, we talked about this when I first started the stream. There is a very big difference between a market that opens with a gap where it opens above or below the previous day's range and a market that opens inside the previous day's range. Opening with a gap would have meant we already had momentum. So we could look for trades immediately the moment the opening bell rings. But the fact that we're opening inside Friday's range, even though it's just a few points difference, you know, if we were just literally just 2 points higher right now, it'd be a whole different thing, but it matters. And if you track these things day in and day out over a period of years, you will find it makes a big, big difference for a market, whether it opens with a gap or it opens inside the previous day's range. So now we're seeing this as a chop zone, which means we're thinking it's going to go sideways inside this area. Now, why did I choose the levels that I chose? Well, the base of the single prints up means that there were buyers from the lows on Friday that were still long at the end of the day. Okay. If the market can find support above the base of those single prints, there's no reason for those longs to exit. So the market can keep going up. But if we get below the base of those single prints, guess who gets squeezed? Those longs. So then we look for a pullback. So at that area, 64.16, if the market gets new selling, I can look for a short to head down towards yesterday's low because I know we're going to squeeze those longs from yesterday, right? From Friday. Same thing with Friday's high, right? If there are buyers that are inside, you know, the market that bought it Friday, if we get above Friday's high, they have no reason to exit. But if the market starts to come back down, well, then they get squeezed. So by understanding where these key areas are, where people are going to change their minds, where the current market participants are going to switch and do something else, that's where you look for the best opportunities in the market. Speaking of which, we are now pushing into yesterday's high. So this is the moment of truth. If we can get above 64.31 and find support, that is very, very bullish. Our first target to the upside is going to be 64.45, then 64.49, and then 64.59. Okay. If we cannot stay above Friday's high, we're going to turn around and head back down for 64.21. So right here, right now, the bulls either remain in control or the bears start to take control. We are at the chop zone high. Let's see what happens. Right here, right now, right here. Now, this is a great moment to be looking at Bookmap, to be zoomed right in and saying, what is happening with price action right here at the previous day's high? Who is doing business? Is it stops getting taken out? Is it icebergs reversing the market? what kind of participants are doing business right now. And what do we have? Iceberg at the low, iceberg at the high, iceberg at the low, iceberg at the high. So what we have here is chop, right? The machines are going to try to cross through the opening price a bunch of times before they make whichever move they're going to make. So we can't yet predict which way that move will be, but we know there's going to be some shenanigans. They're going to reverse a couple of times. They're going to make it look like it's going up, and then they're going to make it look like it's going down, and then they're going to come right back up. There's going to be some chop here. DNK says, I don't think I've seen 4 weak lows or 4 poor lows before in a row. Yeah, I have. And it's always the same case, which is it's very frustrating because I sound like the boy that cried wolf. I'm telling the chat every day, guys, be careful. We got a bunch of poor lows. This market's going to pull back. And then it just goes higher the next day. And then I'm like, guys, be careful. And then it goes higher the next day. And I'm like, I'm like, I know we're coming back for these poor lows, but I just don't know when. And so I have to wrestle with that in my mind. And that's what I was thinking about this morning. When I saw this move that we got over the weekend, and I saw that at the time it looked like it was going to be a gap up, I was like, man, I so badly just want to buy puts. Like, I so badly just as a swing trader want to get heavily short this market, but I know from experience it will shock me how far the FOMO can keep going. So until, like I said, we either close inside yesterday's range, or if we can dip back down and get below yesterday's low, or we just spend a ton of time in bringing a ton of volume to the downside today, like some sign that the market has rolled over, I can't do it. Not yet. Percy, good morning to you. Mo in the house. Sup? Willie T is here. Frito. Tim. Tim says he's older than 44 as well. Well, Tim, did you watch my video? Because YouTube doesn't know it. Will, good morning to you. Danny G in the house. Grizzly Bull is here. Aguz says, I'm probably mispronouncing that, my apologies, says, I am being said that I am a clever person. Actually, I'm a profitable trader who is trying to create an edge from Bookmap, but nowadays I am questioning my IQ. So here's the thing about Bookmap. There are some tools in trading that give you very exact things. Like, for example, a Bollinger Band, right? It's like a very exact thing that you're at the Bollinger Band, you're above it, you're below it, an Ikemudu Cloud, a VWAP, RSI. There's a lot of different indicators that exist in the world of trading that give you like very exact things. Like if it is here, it means this. If it is there, it means that. I have found that the ones that are the most reliable, which is Market Profile and Bookmap, which is why that's what you see on my chart right now, I see on my screen. The ones that are more reliable like that, they never give you exact references. But those other ones that I'm talking about will be wrong all the time. And when they're wrong, you will be wrong in your trading because, you know, it told you we were heading back to the VWAP and we never got there or whatever it is, right? So the ones that are a little more murky, that are a little less clear on this is exactly what's happened, are actually the better ones to use as a trader because it requires your brain to learn nuance, right? You have to learn to look at these things and not think about them like this guarantees that this is going to happen or that guarantees that that is going to happen. And when you do that, your brain goes through something called chunking, where it begins to take multiple, often contradictory pieces of information and combine them together. And by combining them together, you actually have a better insight of what is likely to happen than looking at any one thing on its own. So for example, if all you looked at was value areas on market profile, you watched the market get above the value area from yesterday and come back in. So you would naturally be thinking, I should go short and target a move to the opposite end of value, right? But when you combined the icebergs that we were seeing in Bookmap, you can add the nuance that the market is probably going to chop and grind through the opening price a bunch of times, right? That's what the market is telling us right now. The current market generated information, being the icebergs that are showing up in the order book, is telling us that there are bots, machines that are trying to get people long and short right now. Okay. Now these bots or machines don't care whether you go long or short. They just want to build liquidity one way or another. Why? So they can sweep order books. Let's say they want to take the market lower. They go sideways, they go sideways, they go sideways. They poke up one more time, clear out all the sellers, then they go lower, or vice versa. They go sideways, they poke lower, they clean up all the longs, and then they go up. And so the simpler you make trading, the more exact you make it, the worse clarity you'll have. The more nuance you bring into it, the more clarity you'll have. And the tricky part is you can't learn it instantly. The nuance requires screen time. It requires sitting in front of the computer day in and day out, letting your brain build that neural network, letting your brain learn this complex thing, and coming at it from the point of saying, it's not going to make sense to me right away, but I'm just going to keep watching it every day. Okay, so here we go. We're starting to break out of this little range. And what do we just do? We took out a bunch of stops. What do we just hear? Click, click, click. Okay, so now is when the change comes. If the market continues lower from here, it's heading lower. If it turns around and heads back up, it's heading higher. Now is the moment where we can start to enter trades. And that trade is either for a look above and fail of yesterday's high or a break higher. And it's a failure. So the first target to the downside is 64.21. If the market passes through 64.21 and then reverses back up through the opening price, that means this is likely the low and we're about to head higher. If the market passes through 64.21 and comes back up and gets resistance, it means we need to head down towards 64.16. If the market passes through 64.16, it means we need to head down to 64.10. And we just continue to monitor for continuation lower from there. So as a scalper, we're bearish now, and we're looking for resistance that we can sell. Okay? Once this weak reference is repaired, we look for what comes next. As a day trader, we're back inside the chop zone. And as a swing trader, it's still too early to tell. I'm talking about a chop zone. Okay, so the next question, do they turn 64.29 into resistance? The sellers took control. They swept the order books to the downside, and they continued the momentum lower from there. So now all they have to do is hold the resistance, and the market is going to head down to 64.21. If they can't, the market will head back up above 64.32. Can they hold it? I'm talking about a chop zone. Pig says, coming back for the poor lows, but don't know when. Therein lies the conundrum with every thesis. It's the when a trader needs to know to capitalize. I would argue that a trader never knows the when. So here's the way I think about trading. Imagine you created an adoption curve for every single move the market is going to make. So this represents every single person that is going to go long or short, or, every single contract, whatever, you know what I mean? The volume of a particular move. So let's say the move is going to be to the downside, right? At the beginning, you got a very small group of people that start shorting. Let's say they're shorting the very highs, right? These people are innovators. They're very smart. They just know intuitively exactly where to get short. And so they're the very first ones. Well, there's not a lot of people that are doing that. At that moment, the market is going up and it's at the highs. So most participants are actually bullish. They actually think the market is going to go up. But there's a very tiny group that recognize that it's done going up and it's going to start going down. And they're the ones that are shorting right up at that high, right? Then you've got the early adopters that begin to get in. They see that the market rolled over and they're thinking, oh man, we're coming back for this gap fill and I want to get short. So they're getting short in here, right? So if we're looking at this profile from the overnight as an example, right? All these traders know there's a gap up. They know they're above, Friday's high. And so they know that if the market can't keep going up, it's going to come back down into Friday's range. And so you got your innovators starting to get short up here. Then you got your early adopters starting to get short in here, right? That's the next big wave that comes in is your early majority. And that's the ones getting short in here, right? That early majority. Then you got the late majority. The ones that the market pushed its way all the way back down. It was basically at Friday's high, and then they were shorting right there, right? That's your late majority, okay? And then you got your laggards. Laggards are the ones that wait until the market has already dipped down, then they short at the low, which is when the innovators for the next move are stepping in, and then the market comes back up, right? So that's every move the market makes goes through that process of early adopters, innovators, early adopters, early majority, late majority, and then laggards. And it's not just moves in the stock market. It's every adoption of everything on earth. If you're talking about people driving automobiles or people using cell phones or people, using ChatGPT or whatever it might be, every new thing that happens in the world goes through this same adoption curve, right? So my goal as a trader is not to try to pick the top or the bottom. I'm not trying to know when the move is going to start. What I want to know is after the move has started, can I get in early enough in that move that there'll be a chance to take profits because there's more people coming after. So if I was going to short for a gap fill, if I was trading over the weekend, I would not be trying to short up here around, 64.55, but I would want to be getting short here around 52, 50, because I know there's a lot more sellers to come in. So if I'm using the high as a stop and the overnight high as a stop and the previous day's low as a target, the previous day's high as a target, well, then my risk to reward on that entry is good. And the probability of it happening is good because there's a lot of people that are long that still need to change their mind and get out of those longs, which are shorts entering the market, right? So that is my goal as a trader. I can't always time things, but I can know what to look for at a certain level to tell me what's coming next. So we talked about the sweep of the lows and the new selling. So now we're looking for resistance literally right now. As long as we get the resistance right now, as long as we get the resistance right now, I can go short in here using the current high, we'll say a point above it. So that would be 64.3250, right? As a stop. And I can target a move down to the base of the single prints at 64.16. So my risk is less than my reward. My probability of success is is higher because we've already had a look above and fail of the previous day's high, and we're getting that resistance. We're getting that new selling. Now, do I know for sure this trade is going to work? Absolutely not, right? Generally speaking, I never know if a trade is going to work or not, but I'm just building up a thesis. I'm finding an opportunity where my reward is better than my risk, and I'm entering the trade. I'm taking on the trade. Well, let's say the trade doesn't work right now. Let's say I'm just wrong. I think I'm seeing resistance. I think the market is going to go lower, but it doesn't. It pokes back up. What's the good news? Well, that tells me that the adoption curve of sellers is over, that we just made the low of the day. The last guy that was willing to go short had gone short. And so even though I may get stopped out of my my short trade at that moment, what can I now look for? Look for the market to make a move up, look for it to come back down, and then I can buy support. So this is the way you play it. You go short with a tight stop and a better take profit. If the market comes up and stops you out, you wait for a dip, you go long with a tight stop and a better profit. And maybe you get stopped out on your first trade, but then your second one works. And the second one pays for the first one, right? So if you can do that with your trading, if you can be patient and wait until some sort of momentum is created, wait until you know the adoption curve is happening, either to the upside or downside before you get long or short, and you do so at strategically advantaged areas where if the trade doesn't work, that is information to tell you what your next trade should be. And that information means the odds of your next trade working are much higher. Then over a series of trades, over 10 trades, 20 trades, 30 trades, 40 trades, you will be profitable. You will have more winners and losers. And that's what works for me, because I will never be able to guess the high. I will never be able to time a perfect entry, but I can make more money than I lose. And that is how I do it. I go over all of this in full detail in my Mastery of Markets and Minds workshop. We got one scheduled coming up in September. So if you are interested, just head to marketsandmind.com to learn more. Or you could just join the brigade. There's a link in the description at the top of the screen for the Pirate Traders Brigade. That is where I do these live streams every day, every morning. And I share my insights just like this. Because of the chop zone. Jason says, hit that like button for the excellent play-by-play. Smash the like today. We got 134 people hanging out and 52 likes. That means more than half of you hate me. You don't even like me enough to push the button. The Discord's being quiet today. No questions from the Discord. It's just me, Dan, and Trader hanging out. Pig says thorough explanation. So the key is recognizing when the move is underway. Yes. And more importantly than recognizing when the move is happening, which is always still a guess, it's recognizing where the move starts, right? Where do traders change their mind? Where do, we talk about old business and new business, right? So if people are already long, right, where do those longs say, fuck, I don't want to be long anymore, right? I don't think this market's going to keep going up. And then once you get to that level, if those longs start to exit, do new sellers start to get in short? This is those key moments of where do these things take place and what happens when you get there. That's the edge in trading. So I use market profile to know the wheres, and I use Bookmap to know the what's, to know what's happening based on changes in order flow in real time. For example, right now, I still think we're heading down to 64.16, but the order flow is telling me they're going to grind and grind and grind right on this opening price because it's still working. Going down is bringing in longs and shorts and longs and shorts. And so they're going to keep grinding and grinding and grinding here until they break lower. That is not a sign of support. It is not a sign that the market is ready to head up by any means. It is just a sign that the bots want to get everyone long or short first before they make the break, which might happen right at the clock striking 10 a.m. Do we have any news this morning, guys, coming out of 10? Because that would be a great moment for them to just boop, boop, poke down. They spend, 30 minutes going sideways, and then they make the move in 30 seconds. Is it possible to give information about the indicators on the top right, the icebergs and stops? Yes. So when you see the two little triangles, that is a sign of an iceberg. Okay. So what is an iceberg? Think about an actual iceberg. You got the ocean right here. You see a little bit of the iceberg above the ocean, but there's a big, huge chunk of ice below the water. And even if you can see the chunk of ice above the water, you never know how big the chunk of ice below the water is. So that's what an iceberg order is. It means that they are using a machine to hide their size. The way it works is it will put one single contract in the actual order book. But the moment that the order book gets to that level and fills that contract, a high frequency trade will take place where they will just put another contract and another and another and another in a fraction of a second. They just keep adding more and more and more and more and more and more and more, more, so that price can't pass through it until all the liquidity that they want to fill there gets filled. So for example, here they wanted to fill 109 contracts. So that iceberg remained there until the full 109 was filled, and then it went away. Same thing up here. They wanted to fill 42 contracts. Once they got to 42, it went away. So when you see an iceberg pop up, if it's still there, and I'll point it out once we have one, it means they're probably going to come back to that level at some point because there's liquidity waiting to fill at that level, right? So that's what we do with the icebergs. If there's an iceberg that's left behind and the market is moving away from it, it increases the odds the market will come back. So let's say this selling iceberg had still been there as the market was moving lower, that it would mean they need to come back up and fill that. So you'd be less likely to get bearish at the lows. You'd be thinking, I'm going to wait for the pullback and then see what happens at that iceberg. Okay. Here's one right now. So let's zoom in and we'll see. Oh, no, already filled. And then the stops, the way I have the settings set up, it's only when there's like large orders that are getting stopped out. So this was 145 contracts getting stopped out at the exact same moment. This was 12 contracts getting stopped out. Anything over 10 jumps up for my thing. So that was 12 contracts getting stopped out at the exact moment. Up here was 65 contracts getting stopped out. If it's a red dot, that means they are buyers that got stopped out going short. And if it's a green dot, they are sellers getting stopped out going long. And so when you see this right here, where you got icebergs on both sides of the market. Green icebergs at the low, red icebergs at the high. You got stops on both sides of the market. That is a sign of what we call bot shenanigans. That is the high frequency computers intentionally just keeping the market range bound to build up the momentum for the break. So it's like a jack in the box. You know those old jack in the box things where you twist the handle and you keep twisting and you keep twisting, and then out of nowhere it's like, "Ba-doo!" and it like jumps up and freaks everybody out. It's like that. They just keep twisting and twisting tighter and tighter so that whenever they break, there's more people to freak out. There's more people to squeeze on one side or another. And you often don't know which way it's going to break. So if you feel you have an edge, if you feel there's a higher probability it's going to go down, you're in your short with your stop at whatever the upper end of that range is. If you feel it's going to go long, you have your stop at the lower end of that range. And if you get stopped out, you have valuable information that we just broke out. So now we can start heading in that direction. And so you change your mind, you start trading the other way, you make back your losses. Welcome to professional trading. It's not about being right or wrong. It's about being positioned for whatever happens. Rich says we got no scheduled news at 10 a.m. Well, that's a bummer. It means we're going to keep grinding here until somebody with big size gets squeezed, till we take out somebody big. That'll be a stop of more than, 40 or 50 contracts. It's so choppy, very choppy. This has also become the new norm. This is the third trading day in a row with a super tight initial balance. So that is a sign that what's been happening over the last few days is still happening. Sometimes the market can be a real douche. Okay, so how do I see things? Right now at this moment, I still think the higher probability is a pullback down towards the, at least below 64.21, towards the 64.16 area, okay? If the market is able to get back above yesterday's high, get back above 64.31, and it starts to get some buying up there, then I am wrong. And the exact opposite is happening. In that case, we're heading up towards the overnight high. Okay. So I'm bearish right now, but we're just a few points away from me changing my mind if we get new buying above 31. Okay. I don't necessarily think we have to go any lower than 64.16. It's a great place. It's a base of single prints from Friday. That is a great place for the market to find support and reverse up out of here. So for me to be bearish below 64.16, I would need to see new selling there. I would need to know that adoption curve of shorts is still happening in order to think we're heading down to 64.10. Okay. So this is kind of a tricky moment. It's a little bit choppy here, but I am still biased to the downside for the ES as long as we are below Friday's high. Like I said, watch how quick I'll change my mind if we get above Friday's high, because that will mean we're going to squeeze all the sellers, which as of now, there are more sellers. So that would be a bigger squeeze to the upside. If you are a member of the Pirate Traders Brigade, head on over to the private stream. I will see you there in about 2 minutes. If you're not, why the heck don't you join? It's only $20. That's less than 2 ticks on the ES. If you can make 2 ticks of profit in an entire month, you've paid for your membership. I mean, to me, that's ridiculously easy to join and give it a try. I do these live streams every single morning, and we'd love to have you in the brigade. Thank you all very, very much, and we will see you bookmappers next Monday.